Question 4 was a very, very difficult question, just because it didn't look like anything we'd ever seen before. And it's when you break it down, it was actually a topic that's usually well done, which is doing reports and balance day adjustments for expenses. But the main issue was there was a lot of info, a lot of writing. So what you were told was Chris Stone established a small business, Willow Terrace, to sell outdoor furniture. He'll use control accounts and subsidiary ledgers for debtors and creditors. The business officially commenced on the 1st of June with the following transactions, and there was a whole bunch of info. And what you were asked to do was just do a balance sheet. Now, if we asked you to do a balance sheet, normally you'd be quite confident with that. The problem here was it just didn't look like anything that we'd done before. There were no journals, there were no ledgers to post. So I think that the main issue here is really just to simplify this question. Just break it down one point at a time and use a grey lead and put each transaction in your balance sheet and then move on to the next one. Now what you want to remember is that every transaction must have the accounting equation be true at the end of it. So your assets must always equal liabilities plus owner's equity. So if you do that for every transaction, you're going to be fine, because that's all the balance sheet is, a collection of transactions where this is true. So what we want to do with the first one is figure out Chris gave the business a check at $40,000. That is just a capital contribution. So we've got money going in, which would be a current asset, and then he's increased the capital in the business, so owner's equity or capital would go up. And what we want to do is just check that the accounting equation equals. So we've got assets of 40, we have no liabilities, and owner's equity of 40, and that balances. So I think we write that in grey lead, and now we move into the next one, and we can rub it out when we need to make changes. So the next transaction was the business took out a loan of $20,000 from any bank. So first of all, we've got more money, so that bank figure needs to go up from 40 to 60. Now, the loan, it says, is repayable over 2 years or 24 months. So what we need to do is split that loan into current and non-current. And what we can do now is check that assets of 60, liabilities now at 20, owner's equity is 40, so our accounting equation balances. Next one, this is the toughest one. The 3-year rental agreement was signed. There's rent of $5,000 paid for the next 3 months. So rent has GST, so we'll get to the GST in a second, but the rent itself is prepaid for the next 3 months, so we better put that in as a current asset called prepaid rent. Then we got this security bond. This had never been on the exam before. It's quite unfair to expect people who don't, students under the age of 18 or just turned 18 who don't rent themselves to know what a bond is. But basically it says here it's kind of almost a deposit, and it says you'll get it back once you're done renting the premises. So I guess it's almost like putting money in the bank and not being able to touch it, but being able to get it in, 3 years when we stop renting the premises. So it's actually an asset, and because we're not going to get it back for 3 years, it's going to be a non-current asset. What we're forgetting though is the GST, and this is where it was very, very difficult. Is there GST on rent? There is. Now we've paid GST, so when we do that, our GST actually becomes an asset. So we'd go into current assets for $500. But is there GST on a security bond? And there actually isn't. It's difficult for a student to know that, and on the exam there was actually, if you did put GST in for this, there was no penalty. I think it was a bit unrealistic to expect students to know whether it did or didn't have GST, but for the sake of being accurate, a bond doesn't have GST. What we're forgetting though is that we've basically paid $9,500, but we haven't factored that in yet. We haven't decreased the bank figure. We still got bank at $60,000. We better decrease that to $50,500. So now if I go and add up all of these numbers here, they actually still come to $60,000. I've got $20,000 of liabilities and $40,000 of owner's equity. The next transaction was a little simpler. The owner's giving the business a vehicle. Now it's valued, so its agreed value is $24,000. It originally cost $52,000 plus GST, but that is for Chris as a person. So we don't know when he bought it. Could be 3 years ago, 5 years ago. That figure is actually not relevant to the business. It's the agreed value is the figure we need. So we've got a non-current asset called motor vehicle 24. But we've only got one thing happening. We need a second thing. So what's happened here is the owner's made a capital contribution, not in the form of money, but in the form of a car. The effect is the same though. Capital will go up to $64,000. So looking at our accounting equation, assets have now gone up to 84. We've got liabilities of 20 and owner's equity of 64, so that balances. We've then got shop fittings. We bought them for $30,000 plus GST. They're on credit. Now this is for a non-current asset that's not stock, so this will be a sundry creditor. But it does say we already paid $4,000, so very complicated. So let's take it one item at a time. First of all, we've got new shop fittings for $30,000. We've been charged $3,000 GST, so that'll make our GST asset increase to $3,500. We're going to have a subsidiary, a sundry creditor called BFit for $29,000. So we got that by taking the $30,000 of fittings plus the GST, which is $33,000. Take away the amount we've already paid, and we'll get $29,000. And what we need to do is update the cash figure. This figure here needs to go down because we've actually paid $4,000, so we better decrease that to $46,500. So we go and add up all these numbers here. We'll get a total assets of $113,000. We'll now have liabilities of these three numbers here, which if we add together is $49,000, and we've got owner's equity of $64, and together these two numbers here actually do equal $113,000, so we do balance. The next one, we bought stock for $38,000 plus GST. It was bought on credit, so I have a current asset called stock control going up. I've been charged GST, so whenever I get charged GST, that increases my GST asset. So this number here will need to go up, so we'll increase that by $3,800 to get $7,300. And we bought this on credit, so what we won't do is we won't add that to the sundry creditor. Sundry creditors are for buying non-current assets. When we buy stock on credit, that becomes creditor's control. So rebalancing all our assets, we get total assets of $154,800, liabilities of $90,800, and owner's equity of $64. And together, these two numbers equal $154,800. The last thing we were told was there was an order for more stock. Now, going back to the beginning of the year, orders are not transactions. There's no legal obligation for either party to follow through with this transaction, so we actually don't need to put this in, we can just ignore it. So if we balance out our accounting equation, we keep the same balances, we're all good. To finish the report, we better total it up, so we'll total the current assets, the non-current assets, total assets, we'll get current liabilities. If we total all those up, we get $154,800. Total the current liabilities, the non-current liabilities will total capital, and total liabilities are $90,800, total capital there, which leaves a total on the equity side of $154,800. Looking at the marks, we had one mark for bank, one mark for prepaid rent and stock control together, so you needed both, one mark for GST, one mark for the bond, one mark for vehicle and shop fittings together, one mark for splitting the loan into current and non-current, one mark for the sundry creditor, and one mark for creditor's control, which is 8 marks, which interestingly enough leaves no marks for any of the totals or the capital figure. So looking at the results here, we can see if we just look at the people who could get 4 out of 8, that's basically most people. So 25% of the state couldn't get 1. But yeah, not many people could even get 4 out of the 8 marks. The average out of 8 was only 2.6, which is very low. Now, if we look at the percentage of kids that got everything right, it was only 3%. So let's look at some the examiner's comments. Students found this very difficult, this question. I think the best way to do it was the approach I showed you, where you just do a new balance sheet after each transaction and rub it out, use pencil. Important to note, there's no marks for totals or capital. So that's somewhere, it's not, I think you do them, but even though if you have them wrong, save going through it until the end of the paper. Wait till you've finished every other question, because totals might only have 1 mark at most, or in this case they had 0 marks attached to them. It's important to recognize with this question, it's a good representation of other parts of the exam. Sometimes there's a mark for an individual number. So in this case there was, let me just go to the slide, apologies. There was a mark for the individual number. So if you just put in bank, for example, you actually got a mark. So looking here. But for other numbers, you needed to put in 2 things. So in this case, prepaid rent and stock. So if you just note that sometimes there's marks for individual numbers And sometimes you need to give a whole group of numbers in order to get one mark.